Well, good afternoon, investors. Welcome to the October 11th, 2022 edition of Bull Sessions. My name is Mark Robertson. I'm here joined by Ken Kabula. Good afternoon. Good sunny afternoon to you, Ken.
Good afternoon, Mark. It's beautiful up here today, so let's keep this thing as close to 3 o'clock as we can, okay?
We'll do the best we can. We've got a little bit of volume to go over today, but not too bad. Just going to do some quick updating and make a few stops. I did actually throw together a few responses to some questions that we've received, and I want to get that process more formalized and something going forward. I did want to try to find a picture of Roxy to put that envelope in her mouth, but I had to settle for that dog on the left. And Titan's busy laying in the sun, so I can't get one of him either.
But Roxy is laying right at my feet here, looking at me and saying, "Shut up, I'm trying to sleep."
Why does that man keep saying my name? All right. And then, again, not to talk too much about baseball, but I do want to spend just a few moments talking about batting practice. And the catcher there is Yadier Molina, who just retired this past weekend. I was actually in attendance for his last game along with his buddy, Albert Pujols, one of the best players in the history of baseball. That's his picture right down the middle there. Just want to talk about that a little bit. And again, for those of you that are not sports fans, it's really not about sports. It's about something completely different. So stay tuned. Ed Harris still here being vigilant in our last 20 days for this year's best small companies. As of a few minutes ago, the Russell 2000 was 1.5 points ahead of the rest of the stock market. So that might be good for us. But our small company rabbits are giving us a little bit of a troubling experience this year, and we'll talk about that. And if Ed Harris can't do it, I think I sent this to you before, Ken, discovered a beverage by the name of Dead Rabbit. And I thought maybe we could get away with threatening them. This is actually off the desk of Bill Mann at the Motley Fool.
What is it, bourbon or Tennessee whiskey? What is it, Mark? Do you know?
I'm not sure, but I think it says Irish whiskey on there. So the
okay,
Dead Rabbit.
It might.
So
it might. I can make out whiskey, but I'm not getting the first word real well there. Well, so
I'll get a better picture if we need it. If fear is what we need to get some performance out of these rabbits, we'll have to get them. And I do find it interesting that he's got the Invest Better. There was a day that the Motley Fool put on a few years ago called Invest Better Day, and that's what that coffee cup is from. So I thought it was kind of an interesting picture.
A strange turn, Mark, but who's the guy they called the captain on the Yankees, the famous ball player?
The captain on the Yankees?
Yeah.
Well, Derek Jeter.
Derek Jeter. I don't watch sports things at all for the most part, but I happened to stumble across a biopic on Derek Jeter.
Yes.
And it was one of the better programs I've seen in the last 60 or 80 days on television. If you happen to get it at some point, take a look at it. Really, really well done, going through his entire career and then moving on to what he's done since he's retired. Really nicely done program. No blood, no gore, no nastiness, just a really well done program about a real hard-working individual.
Well, that's cool. I actually have my television set to filter out anything New York Yankees, but
okay,
we'll see. And by the way, you should be doing cartwheels over your Cleveland Guardians / Indians.
Well, I know you told me they're in the playoffs. That's so unusual. I'm still processing it here, Mark.
They're playing the Yankees probably starting today. So, all right, enough of that. We'll come back to it in a second. Here's our standard disclaimer. No investment recommendation is intended. This is all about taking the lessons learned over more than 8 decades in the modern investment club movement and basically try to capture and demonstrate for you and working together, all of us working together, to share the analysis and portfolio design and portfolio management that is literally 8 decades in the making. Quite a bit of success out there. Again, nothing is guaranteed, but we'll express some opinions here. Please do your own homework before making a decision. We'll try to remember to disclose if we actually hold something that we're talking about in our personal portfolios. Our monthly webcast known as the Roundtable is a few weeks off, but if you'd like to be added to that Roundtable reminder list, it's just an email, just reminding you when it's coming on. It's usually the last Tuesday of the month, 8:30 Eastern Time. It's a webcast. Please send an email to nkavula1@comcast.net. If you have any other follow-up stuff, including any questions that you'd like to inject into the mailbag, Mark R at manifestinvesting.com or kcavula1@comcast.net. All right, here's our start. Again, the point to be made, return forecasts are settling in at a little bit higher level than they've been in a while, meaning that there's a few more stocks in the buy zone these days. We do believe in that long-term blue line, and that the green line, which is represented, it is a representation of the stock market. It literally is an index value based on the value of the 1,700 companies in the Value Line Standard Edition. So that's what the green bars are. The red are a forecast, the average forecast of the companies in the book. And of course, the blue is just simply a mathematical or computerized trend. So one of the things I did, Ken, and I think maybe you suggested this, took the forecast thing out just so we could take a look at just the price versus the trend. And again, it shows the holdings.
Keep on making the point that last green bar is a work in progress and won't be finished until the 31st of October. So that one's still subject to moving up or down or staying right where it is, for that matter.
In fact, it's Christmas, so it's that green bar locks in on.
Oh, I'm sorry. We're at quarterly bars, aren't we? Okay, right. Yep.
So we are in the Jackson Abyss after Jackson Hole. This all started back on August 16th, and we'll just see ultimately how painful it is. But again, I have the ultimate faith that the blue line is the right line. And this was probably a little fluffy here. That's a highly technical phrase. A lot of that was probably a little bit fluffy. Here's another reason that I think it was a little bit fluffy. Here's a look at the value line forecast versus what actually happened. I know this is a little bit busy. I don't want to give you a headache in the afternoon, but what you're basically looking at is the forecast according to value line. Again, talking about the stocks that are in this mix. You know, what is the forecast? That's what the red bars are. What is the forecast? And what the green line, the dots, and running through that are what proceeded to actually happen. So it's just a traditional comparison. There's a 4-year mismatch on here. So you actually are lining up the forecasts made with what actually happened 4 years later. So at the end of September, we would have locked in this most recent point here. You see over here on about 4/5 of the way across the chart. The forecast back in September 2018 was 8.8%. We actually came in at 4.1. So that's where that green dot is. And again, the point that we have made for quite some time is, again, we think that the method that we use is very similar to, it's certainly a cousin to the value line approach. They emphasize cash flow more than earnings, but it's an indication of how the stocks that have been featured and how the forecasts have done over the last several years. And, you know, when I stand back and look, and with some exceptions, I mean, this got a little bit crazy over in this time frame here, but with for the most part, I think that those green dots follow the red bars pretty closely. What are your thoughts as a world-class mathematician, Ken?
Well, I'm looking, Mark, and I'm just noting to myself the word that kept coming to mind for me was pendulum, and I'm looking at from the depths of the great financial crisis in 2008-9. I'm looking for the green dots, which tended to underperform. Excuse me, the red bars just a little bit, and then we reach a peak on the red bars in 2012 at the end of the year there, and now we're underperforming. We're overperforming, underperforming, depending on which one you want to talk about, but the green dots are under the red to the left and over the red to the right. To me, that's just that pendulum swinging back and forth, where the analysts, I think, tend to get a little bit too pessimistic sometimes, and then to fix that, they get a little bit too optimistic, and they go back and forth in that general rhythm.
And the one thing that I had not really noticed before is, this which I refer to as fluff right here, shows up right here. Because again, keep in mind, those are actual returns. They were a bit fluffy. So I look at this, and again, I think, longer term, and we're certainly going to talk about with the best small companies in a minute. I mean, I'm looking at these forecasts, which are down the road. I expect the green to come up into this and live somewhere near that neighborhood. And then this doesn't hurt a bit either out here. So longer term expectations, probably pretty good. This is the type of data that Hulbert has featured in the Wall Street Journal a few times when we've talked to him about it.
Yeah, I'm looking at these 5 green dots that you circled right there, Mark, and I'm thinking to myself, 0% interest, all kinds of stimulus into the economy. Why wouldn't you expect things to really exceed what you thought was going to happen 5 years in the 3 to 5 years previous? Why wouldn't that happen with all that stimulus? And it leaves it up to the imagination now, where it's going to go 3 to 5 years from now.
Yeah, and I just wish that Jerome Powell didn't think he has to fix it in a couple of months. I did notice that Kathy Wood wrote a open letter to the Fed asking them to stop raising interest rates. So we'll see how that goes. Here's that same look at the value line arithmetic average over time, again, making the point that, we're in, as Sean has pointed out, you could basically say that we're in a very similar time period, at least in the shape and the characteristics of the trend back from 2008. I would say we've been in pain long enough that I don't expect the pain to last that much longer. I have no idea what's going to happen. I don't know too many people that really do. What I do know is that was pretty severe back in 2008. There was a long-term death cross where that red arrow is. We're nowhere near that right now, so we'll just keep an eye on that. I mean, if we do get into a death cross situation, that's where this red line crosses the blue line. Probably will have some extra pain. I might be tempted to hold on to a little more cash if I sell things. In that situation, trying to catch one of these moments in time, this one or this one. But I don't obsess over that.
And just to keep it clear for the audience, Mark, the red line represents the yearly moving average. Is that correct?
Yep, that's a 12-month moving average versus a 5-year moving average. No technical. Go ahead.
So it's pretty simple arithmetic being used, and it's just talking basically about short term. But for us, short term isn't a week or two; it's a year or two for short term, right?
Yeah, absolutely. And that's another blue line that we have a lot of confidence in. Also, it's in the right direction. It's in up, straight, and parallel mode for sure. Taken collectively. All right. So let's talk a little baseball. I'm not sharing this. I am a Cardinal fan. I am a diehard Cardinal fan. I actually made the trek to St. Louis for the game on Saturday evening. It was I had never been to the new Busch Stadium, so all of this is just icing on the cake. But what I want to share is just some observations. First of all, the loyalty of that fan base. The stadium holds 47,000 people. There were 48,515 of us there. And 99% of them, as you can tell from this picture, are wearing Cardinal attire. So it really is kind of a mind-blowing experience to go through it. You can see that our seats were pretty good. So it was a great situation. We actually watched 2 future Hall of Famers. Albert Pujols, shown here, one of the best hitters in the history of baseball, retired after the game. He actually had a couple of hits, as did Molina, the catcher. It was just a wild experience. But what I kind of took away from watching it, we were there very early. I took in all the pregame festivities. And what I was probably more impressed with, and this is where it ties back into investing, was the batting practice. And for that matter, any of the other stuff like the warming up of the pitchers in the outfield or whatever, but the batting practice itself for both teams, the stuff that they go through, keep in mind these are individuals that probably do this hundreds of times every day, and they're just constantly practicing. Watching them practicing bunting and that kind of stuff, it just such a vivid reminder of the power of practice and being a practitioner. And again, I'll tip my cap since the Cardinals went down to defeat. I was hoping to be in a battle with Cy Lynch's Atlanta Braves starting now, but now I have to turn my attention to the Cleveland baseball team, and I will be hoping that Cleveland prevails pretty well against the Yankees, Ken. But I don't know. Have you been to a baseball game lately, Ken?
Mark, I probably haven't been to a baseball game in 30 years. So,
Okay, so now I'm going to get.
I'll tell you, when I lived in Cleveland, we would go 15, 20 times a summer. But since we've been up in Michigan, it's just it's a combination of a Detroit team that I don't feel any special affinity towards, and distances. It's a long drive to get to the stadium.
Well,
so.
I kidnapped my brother for this one and took him to St. Louis. So now I'm going to have to come kidnap you for Cleveland. So be ready.
All right. Okay.
So here, this is just some reinforcement. I went to the Manifest Investing site and I just entered the word baseball in the site search and hit go. And there are a couple really good articles there that, again, they might be wrapped around baseball, but they're more about investing. In fact, you mentioned Derek Jeter a few minutes ago, Ken. In that Rites of Spring article, when you go to it, he actually talks about a play that, just a miraculous play by Derek Jeter. And one of the most famous plays in the history of baseball. And Moneyball, I don't know if you remember Rich Bulbian from many years ago, but Moneyball is basically a book about trusting the numbers in the Oakland Athletics. And it's actually a movie now. It's been out for several years. It's a good movie. And just a number of articles about this notion of practice, pay attention to trends and numbers. And then I also wanted to share with the audience, I really do enjoy a blog on investing that's called The Science of Hitting. And it features Ted Williams of the Boston Red Sox and how he was successful at picking out pitches to hit. And actually a picture of Williams doing that hangs on the wall in Warren Buffett's office. So just some baseball type stuff. But again, this notion of practicing and going through analysis of stocks and sharing ideas and that kind of stuff. And again, I'm getting warm and fuzzy, but that's what I think our roundtable is all about. Any thoughts, Ken?
I'm ready for the next slide, Mark.
Well, speaking of practice.
Wait, I'm not on the list. I'm not ready for it, okay?
Well, you and Cy have gently slipped off into number 46 and 49. I can't put it on there. You're going to have to up your game a bit. I not to put reckless fear into you, but I have moved up 18 positions since last week or the week before that. So
that opens me up for a number of comments that I won't make at this moment. Okay.
All right. Well, Einhorn continues to lead, but Kay's husband is in the number 2 slot. Kay's with us right now. I think I saw her name on the list, and again, fairly consistent leaders up there. Sean in there at number 19. The annoying monkey up there. But we do have an interesting moment here with both last year's individual winner, Ruth Wilfong, at number 30. And the Space Coast were co-champions in the group contest last year. So it's interesting to see the number of repeat champions at the top of this list year in and year out, and those two basically represent that concept pretty nicely. So we'll talk more about longer term results in the future. Average return is still lacking. We still have the lowest number of contestants beating the market that we've ever seen. And Kathy is still 166th. And she's writing letters to the Fed chairman now. Anything else on that, Ken?
Well, we got 4 months to go yet, Mark. That's a long time in investing metaphors. So let's see where that takes us. Okay.
All right. Speaking of the clock running out, we have 20 days here, not 4 months. And we are narrowing the gap, but I'm concerned that we might run out of time. Hence, Ed Harris and his vigilant watch over everything. And like I say, I'll get out the whiskey bottle if I need to put some fear into this group. But not too many changes. In mode continuing to crank along pretty well. We have a fair number of stocks hovering around the break-even point. But a little bit of fingernail chewing here, definitely merited.
I'll tell you another lesson, Mark, that I think we're forming a platform for, or a basement for, to really talk about, is the lesson that when you have a fairly concentrated portfolio of stocks, not only can one stock carry the whole thing for you, I'm looking at InMode and Ensign Group, both of them doing considerably well, excuse me, than the pack. But I'm also asking myself, the chances of picking a clunker when you manage a short-term portfolio are just as wide as picking an outperformer. And while we have InMode at up 42%, we also have Ranpak at down 50%. So it leaves something to be said about the fact that maybe you don't fool with a concentrated portfolio nearly as often as we've fooled with this one.
Yeah, and Ranpak was simply a play. Again, we could do a whole session on outthinking yourself.
Yep, I got it. Yep, understood
listen,
completely.
I was basically imagining the abatement of the worldwide recession. That's basically the thesis behind Ranpak. And if anything, it's gotten worse. The other thing to kind of make your point, Ken, going back to this slide, this index entry right here is all of the above investing. That's small, medium, and large companies. And this would be a rather formidable result in that context. So you're right. We are definitely concentrated in the weaker performing end of that larger index right now. All right. So we'll continue to hope for the best. All right. I put this slide in here because a couple of you have written basically sending "I hope you get well soon" type cards to us in the email. I need to forward a couple of those on to you, Ken. But they were also asking the question, why aren't you guys more disturbed or nervous or upset? Because you seem to just kind of keep rolling along. And this is kind of the basis. The context for me is I really hope we keep the streak intact of beating, for an 8th year. But even if we don't, it's not exactly the end of the world. And the longer term picture here is this. And even as poorly as this year might be, this gap is not going to narrow that much. And that's kind of how I get out of bed in the morning. How about you, sir?
Well, Mark, it's the same lesson that we're learning from our own contest here in mid-Michigan that's been going for 17 years now. We always put together a portfolio of the most popular choices from all of the entries. And we've learned that in the 17 years, and year number 17 will close this coming Halloween in about 3 weeks. but we've learned that that portfolio beats the general stock market pretty handily most of the time. I don't think you can point to any indicator that beats every single time, but when you can point to an indicator that beats 15 out of 17 times, or like ours would be doing here, beating 7 out of 8 times, I think you have something. And as long as you maintain the same rigor when you're putting the whole thing together, as long as you keep the rules relatively the same, then I think you have some history that you can compare to. I'm not concerned that we lose to the market once in a while, as long as that once in a while stays something like 1 out of 7, 1 out of 8. I'd prefer 1 out of 12 or 1 out of 13. So let's get our rear ends in gear for the next year. But I'm not particularly upset that it loses once every 8 years.
Yeah, I hear you. I still wanted to catch Bill Miller though, like Mason Value. And here again, here's some other context. Going back to just a year ago, what companies actually were in it. This is not this year's. This is actually the year before. Best small companies from 2021. Just making that point, and Ken was just making it. Half that company beat them. Half that list beat the market. Bottom half didn't, but still did pretty well collectively, as is shown by the bar on the far right. So the type of distribution of disappointment is actually not that unusual. It's just a little more red this year than we're used to.
Well, and I think we had a little bit more of the red stocks very close to the 0 point last year too, Mark. What's that? 1, 2, 3, 4, 5 of the 20 actually being within 4 points of 0. Where well, we have more than I thought. 1, 2, 3, 4, 5 again. So that's pretty decent. Yeah, pretty decent.
Yeah, so you are basically looking at it's only a 1 year snapshot, but it is a kind of a rule of 5 moment with the outperformers at the top, underperformers at the bottom, and in the middle. Some really nice numbers down the middle here for the actual returns.
Yeah.
All right. Here's our quick reminder. We are turning now into full gear. Ken and I have been talking about actually systematically going through a lot of these different areas, looking for ideas for this next year's list, because we plan to, even if we are narrowly defeated this year, we plan to put our head down and do better next year, at least try to do better next year. And we've touched on a few of these so far, but we will be going through the list. I'm going to try to see if I can't track down a Hoover's Handbook. I haven't done that in a couple of years. But this is some of the places we'll be visiting during bull sessions over the next 3 weeks or so. All right. And so far, we've been kicking around some names. Here's the current list of companies that are at least on the drawing board. They are ranked by their manifest ranking. And there's some pretty good studies on here. And we will be closely watching them and considering them. I do think I'm probably going to lose a few of these down at the bottom, like the ones with very low quality rankings. There's a couple others on here that just were not really, this 3% is just kind of making me wonder a bit. I'll probably drop a couple of these as we add a couple other companies in. The one change that I did make is I went back and without going into too much detail, we penalize companies for having too high of a projected return. Just kind of too good to be true. In fact, think of it as a too good to be true factor. And I had kind of suppressed that a little bit. I basically threw that back on, and that pushed a few of these companies down the list because, again, when you get up into the 40 and 50% returns, it feels too good to be true to me. And we just wanted to reflect that in the rankings. Any thoughts on any of these, Ken? I saw that, which one was I? Oh, I wanted to ask you, this Metropolitan Bank, I'm going to go to the next slide, which is a collection of banks. And I wanted to make sure that has this one been on your list? Because it's the same, almost the same ticker symbol. This is a listing of banks by
I
highest
I don't know
return.
if that's the same one or not, Mark.
I'll ask you to just take a
There's
look at that.
yeah, there's a lot of the use of the same English and a lot of naming of banks. So I'm writing it down right now. I'm gonna double check it to see if they are the same bank. But if I gave you a different ticker, and I think I did, yes, I did give you a different ticker, I'm going to assume that's a different bank.
Yeah, we just want to make sure that I didn't get it wrong.
Yeah.
Every year I give you selections for your Mid Michigan contest, and you seem to jarble up my
I get
tickers.
I get all of them wrong all the time, Mark. That's why you finish where you do.
All right. So what you're looking at here, audience, is a list of banks. Just want to see if there's any banks that kind of sneak off the radar. These are, again, ranked by highest return on assets. We basically are starting the search for banks which have strong operating performance. The next step would be to dig into any one of these and make sure it's not a flash in the pan, that it's basically a trend that's in place for the company, and then see if it's potentially on sale. There are a few companies with double-digit growth. There are some companies here that have double-digit return forecasts, so something could come out of here. The projected return on values are comparable to the return forecast, so there's a few on there that kind of jump off the list. I kind
We're
of like.
getting a we're getting a question from a lot of folks in the audience. What do the asterisks mean? The entire list has asterisks on it, and that just means that they're not in the value line 1700. They're not one of the most widely followed companies that Value Line puts in its most popular edition, the one that most of us use to evaluate stocks. You'll find an awful lot of these in the extended value line that doesn't have an analyst commentary and that doesn't have very much in the way of forward projections, but there is some coverage for these companies. And the asterisk just means Value Line has, to date at least, not felt that this company belonged in the 1700, mostly due to either size, maybe length of time as a publicly traded company, many times having to do with where it's domiciled, where its main office happens to be. Value Line doesn't cover every single ADR that's out there, and many times I think it'll choose to bypass an interesting company if it's domiciled outside the U.S.
Yeah, and the other one that I'm hearing a little bit of feedback on is, what about some of the issues that seem to be propping up with some of the larger money center and diversified and international banks? I think this type of list is somewhat immune, not always immune, but somewhat immune to a lot of that type of stuff. And they can be a bit of an oasis, a protective oasis in many ways.
Yeah, we're basically looking at banks when we're looking at these small banks that have a pretty simple business model, and it's a business model that most of us understand. They make loans, most of the time loans that have some basis in real estate. They make the loans at a certain interest rate. They take in a large number of local deposits and pay another interest rate to those people that make the deposits. And the difference between what they get from the loan and what they pay out to the depositor is what the bank makes. It's its profit in what goes on. When the quality of the loan package that it puts out there is high, then it doesn't have a lot of default going on. It doesn't have to reserve a lot of money for loan loss and for other things like that. It also doesn't get involved in M&A, in broker issues. It doesn't get involved in a lot of the things that the next size up bank which would be money market banks like Wells Fargo or Citigroup or JP Morgan, which they do get involved with to a great extent. So we're looking at a relatively simple business model. And the smaller the bank gets, the simpler the business model tends to be. And that's where they have the opportunity, because of that simple business model, to really make some money when interest rates begin to move up as they are doing right now.
Another fun fact for you, the next company on this list, if I'd gone one more deeper, was Western Alliance, the company
Okay,
that
great.
did so well for us last year.
Yep.
The other thing that I do get questions about, I have not done a real hard analysis on First Financial, but that has been on an extremely good run. And that's the most of the explanation for the fact that it's the highest quality bank on here by the quality ranking. The return forecast is low because the price has been so well behaved. And I think, Ken, you probably can afford a few steak dinners on your shares in that one.
Absolutely. First Financial is a pretty good size holding in a couple of the clubs I belong to as well. And it just keeps on chugging along. But you're right, the forward potential is a lot less than some of the other banks you can study right now. That doesn't necessarily mean you get rid of the whole thing, but it does mean that perhaps there's room for another bank to occupy some of the money that you had invested in First Financial.
All right, we'll keep rolling on. Well, I'm going to be taking a much closer look at Park Bank Corp, PKBK, in the middle, just to see what that looks like. All right. What I thought we might do for just a minute is, again, we can open up for any questions if anybody in the audience has any. This is a look at kind of our template for what I hope will be the company report pages here in a few days. I chose Starbucks because it is the 15th most widely followed company, and it's got a fairly decent chart. I just thought I would kind of walk through a little bit of what we're seeing here. This is the way I look at Chronicles on the upper right, and you basically are looking at the quality being between 95 and 100 forever, and with a really nice trend there. The other thing that I notice is the projected annual return forecast for Starbucks is at a multi-year high. So these are both fairly favorable conditions. So what actually makes that? What you're looking at on the left-hand side here, this basically represents a preferred procedure-based analysis of the company. Okay, the current price is listed there, obviously, but this particular module here is based on looking at this company as an 8 or 9% growth company. Where does that come from? Basically the historical trend, along with embedded forecasts for this year and the next, and then of course out here also. So 8 to 9% has been a fairly reliable situation, with the exception of that one nasty moment, which everybody here can see. Here, it actually showed up in the earnings down here. That's all COVID type stuff related to the fact that many of their coffee distribution centers shut down for some period of time. So that was a moment which was pretty artificial. They seem to have come back out of that with fairly decent expectations. I'm not sure if, how many Starbucks outlets are enough, Ken, but they are continuing to expand, and even in the international stuff that they're doing, they're having a pretty good time. So again, at an 8% growth rate or a 9% growth rate, we're looking at a $32 billion company becoming a $50 billion in revenues, as is shown by the chart. That's credible. So the next step is to think margin. And the earnings have been pretty up straight and parallel. I think it's fair to say that both of those, with the exception of that COVID moment, are pretty much up straight and parallel. And from an operating margin standpoint, again, that's higher up the income statement. Pretty decent straight line results, somewhere in that 20 to 22% range. That's a very credible thing. Value line likes 24 out here. Not impossible. I'd probably be a little bit less than that. But at the bottom line, they're looking at a net margin somewhere just above 10, maybe 12, maybe 14%. So that's where this number comes from. That's actually the consensus forecast, which is centered more on value line, basically a return to the type of profitability that we were seeing back in here. So again, as we step through that preferred procedure, take a look at the number of shares outstanding, choose a PE ratio of about 24. Again, that might be a little bit rich, but not bad. Certainly credible based on what we've seen back in this history. So based on that set of assumptions, we're looking at a projected annual return of 15%. See a couple of the quality components there that add up to the what goes into the rating up at the top here. Here's your 93% up here. And pretty decent situation. So again, our emphasis on most companies centers on that return forecast, that projected annual return, and the quality ranking, and that's what is depicted historically in those top two charts. Any comments or questions, Ken?
Well, I get a lot of questions, Mark, about how would I, in a practical way, use proof as I'm doing a stock study. And I think this is a great example of how I might use proof. I think that when the difference between the two values begins to be 70, 80, 90% from one to the other, I think that's getting a little bit wide as far as tolerance between the two numbers is concerned. I feel they should be closer, and I wouldn't have any problem at all doing something to lower the par value to be more in line with the proof value. I might go after the net margin, and go from 14 to 13. I might go after the PE value and go from 24 to 22 or 21. But whichever way I handled it, I would be looking to move the par value down just a little bit so that we can then have a little bit more agreement between those two numbers. That's how I use proof in a very straightforward manner to kind of massage the results of my SSG. Now, of course, if par goes down, that might reduce its attractiveness as a purchase, but I would rather buy it telling myself that maybe I have a 12% possibility going forward and be pleasantly surprised rather than saying to myself, well, I have 15, and then being a little bit disappointed when it comes in at 12.
Yeah,
that's how I would do it, Mark.
Yeah, I kind of look at the same situation. I look at this situation down here and say the 14 would be really nice if that actually happens again, but kind of down the middle of all this, 12% makes a lot of sense to me. So if it's my own study, I'm probably going to think that the value line analyst is a little bit frisky. Maybe switch that to 12. Let's see what that does to the return, the projected annual return. This will take just a minute to crunch up because it's linked to the entire database. And then I also would agree with you, Ken, that under that situation, maybe I'd gently ratchet down that PE just a tiny bit. So that drops it down to 11.6. And if we trim the PE just a tiny bit also,
and I think even the 11.6 marks begins to compare.
I agree.
I'm having a terrible day for allergies. I'm sorry, folks. But I think the 11.6 begins to compare much more favorably with the proof number than the original value did there.
Yeah. Well, my internet seems to be running a little bit slow, so I'll go back to the other version of it. Just showing how we condition that. What Ken is basically saying, and I agree 100%, that projected return on value, which is less volatile. It's usually a tiny bit more conservative. But the key thing, and again, you can go back and look at our presentations on the subject, it accounts for total liabilities and cash on hand in the calculation of a forecast. So dropping that down to 12, that alone dropped us down closer to 11.6. So just shows how you might condition a forecast based on this level of information available across the board.
And what's so nice, Mark, is so that so many times when I condition an SSG, I don't actually change the results of the SSG that much. Many times I'm conditioning a buy, and all that I'm getting is a slightly lower par value, but it still says buy. And all that's telling me is that if I'm satisfied with the kind of returns, would I be satisfied for a company this size with a return of 12%? Absolutely. This is a huge company, Starbucks. I happen to own it in my personal portfolio.
As do we.
It's one of only 14 stocks that I own in my personal portfolio, and I'd be tickled pink if all it could do year in, year out is 12%.
Yeah, and then some of the other information.
And that was said tongue in cheek with some sarcasm behind it. So please, it's hard to hear over the broadcast sometimes when you're making a point like that. But that was, I think 12% is a wonderful return, especially for a company of this size.
Yeah, I would settle for less. I'm not. I think I want a little bit more, but that's because I'm greedier than you can. Yeah, a couple things to note. I mean, if you're buying it at the full thing that we shoot for, you want to be 5 percentage points above the average stock. That would be a price of 75. So it's actually not quite at that level, but that's just, again, that's being pretty ambitious for a company like this. The sell reference point is based on the 5-year yield on the Treasury, so that would be 143. We're obviously quite a distance from that. Some other fun facts that we think are important to throw in. Part of the financial strength rating at Manifest Investing for any company is to take a look at the effective interest rate that they're paying on their long-term debt. And in this case, their interest payment of $650 over their long-term debt comes out to be an effective interest rate, which is actually a fairly average number. The average company is somewhere around 4 to 4.5%, but that tells you that the banks basically respect Starbucks when they come needing money. So that's just another component of financial strength, the number that you see up here. Again, not perfect, could be a little bit better, but certainly not bad or less than average. The other thing, whereas it is in the price range, it's actually trading very close to its 52-week low. So that 75 is not something that could be impossible to wait for. It could happen. It could happen over the next several months. So
it could happen tomorrow, the way the market trades.
Well, yeah, as Sean would point out, it can happen intraday. You can move it around pretty good.
Yeah.
But it's down 27% of the distance between the 52-week low and the target price, according to the rhinos, for the next 52 weeks. So it's in a good position. Hugh McManus likes to see them down at 20% or less. The value line and low total return forecast, 13.7. That's pretty good stuff. The Morningstar price to fair value, again, anything under 100 is potentially on sale. If it gets too low, there's some cause for concern, but that's a pretty nice position for a company that's this deep of a blue chip. The analyst consensus also, in fact, they're even a little more optimistic than Morningstar. They think that it's even more on sale. And the relative strength index just means that it has bumped up off of that 52-week low a little bit. And so it's just more information that could be pertinent to a decision on the company. Do we have any questions in the hopper for this one, Ken?
Anything else? I've been checking pretty often. Ann Manning from Texas, Mark, is asking, what do you mean, Mark, when you say this is what we will see on Manifest? Is the equity analysis page changing?
We think so. This is where we're basically looking at providing this information for every single company. and we'd probably change the company report page. If you actually run a cross-check there, everything that's currently on there is on this page and with more. There is actually more information here than on the current company report page. So we may tinker with that here very soon. In fact, we meet tomorrow about that, Ken.
And Ann is saying that sounds fabulous.
Yeah, I think between this and being able to jump around and we'll be one step closer to user inputs as overrides. It's just going to be some fun. So yeah, we'll have some fun with this. All right. Here's our reminder that we archive all of these presentations, whether they're bull sessions or roundtables or just general basic educational sessions. At YouTube, if you just search for Manifest Investing, you can find us. We'd appreciate it if you'd subscribe, and we'll let you know anytime new content is added. So there's a little more celebration of the shots from St. Louis. That is my brother on the lower right. And we were there early enough that we were the only ones near the statue of Stan Musial. Usually there's thousands of people gathered around that statue. Yeah, it was just a good time. And like I say, I got the biggest kick out of batting practice. All right. So, Ken, I thought what we would do is just grab a couple things from the mailbag and tell me if I got the numbers right for Better Investing's definition of company size.
You absolutely did, Mark. And on my list right now is to have an in-depth discussion with some of the people at headquarters about whether or not the time has come to revise this number. Every 6 or 7 or 8 years, this number, because of inflation, has to be revised. When I started in Better Investing, a small company had sales of less than 400 million. You can see how long I've been working with Better Investing, because it's now up to less than $1 billion. Maybe there'll be some revision up to something along the lines of 1.2, 1.3, something along those lines. But until it's actually formally revised, these are the numbers that all the tools that are associated with Better Investing actually use when we're talking about small, medium, and large.
Yeah, and our preference at Manifest Investing, I'm not saying that they're wrong. I'm just saying that the revenue ranges can actually be maybe a little vulnerable. Whereas, Ken just said those have always been ratcheting up or down as inflation creeps over time. Those growth rates for small, anything greater than 12%, for large companies being less than 7%, it percolates around a little bit in terms of just the statistics behind them, but those numbers have been the same for basically since 1940. So
right.
They don't change.
The entire time that I've been a volunteer, that set of numbers has stayed the same.
Yeah, so I just find great comfort in that. It's only so many things fit into my brain, and it's real easy to remember the numbers 7 and 12. All right, next question. This one's actually from today. The other ones are older questions, but this one came from Nick DiVirgilio, and it's just a good opportunity to talk about. Since this is on our best small company list, and it's been a roundtable favorite for some time, Silence has featured it a number of times. There's been a real disturbance in the force here, and it has to do. Nick is right. There was definitely a disruption and confusion, and it has to do with the acquisition of Aditech that was recently added. There's a step change if you look at what's going on with the company. The number of shares outstanding actually tripled in the numbers of shares that they used to purchase Aditech. The long-term debt went up to reflect some of that. The disruption at Manifest Investing comes with the period of days where the analysts were suddenly combining the two companies and presenting the total sum information without perhaps not catching up on the shares outstanding. I know I saw it in some of the Morningstar data that I looked at. And it really points out, as Cy, I think during the presentation that Cy made a couple of months ago, he made the point, let this thing shake out. Let them get the two companies combined, because when you're kind of in the middle of the transaction with respect to the historical data and the future data, it gets real confusing. Would you second that, Ken?
I would second and third and fourth it. I'm not sure that any analyst goes over every single line in a historical report like this before they put it out. I know that they're willing to update based on different things the company sends out in press releases, but I don't think you get a full press release that updates every single number. And therefore, when there's a huge change due to an acquisition or a spinoff for that matter, sometimes you have data that lags, and you just have to be aware of it and give it some time to, as Cy indicated, work itself out. It will work itself out within usually a quarter or so.
Yeah, it used to take us months to catch something like that. We now catch it in weeks, if not days, but it is a disruptive moment. All right, one last one for this week before we'll sign off. Coming up on the hour. This is a question from Steve in Illinois. Enjoying the bull session. What's the warning sign about on my portfolio? He's referring to the little triangle. And I know some of you have also been curious about that. Again, that's an alert. And for companies, I'm gonna propose that we actually do an extended session, if not during a bull session, maybe a standalone session of its own on actually how would you use these better, and especially following what we do with the company reports here shortly. You can add an alert on any company, and actually what you see on the right is I just grabbed a quick screen capture. In this case, it was showing up for Intel. I'm just showing you the same thing for MSC. This is a triggered alert. And you can set alerts based on a number of things: the quality, the par, the financial strength. If the number actually passes through or passes below a threshold, you get an email. And on your portfolios, as it's showing up above, you get that flag just letting you know that something that you've been watching for triggered to take a closer look. And I include Novo Nordisk on this list because I actually ended up buying Novo when the par triggered on it several years ago. I waited, I'm guessing, 8 or 10 years to buy Novo. And I basically waited for that condition to hit, and the alert actually nudged me into buying shares in that company. Been a few years ago. So it's something that I find very useful, but incredibly underutilized by myself. And I know many of you out there too would like to understand how to do it better. I think you'll see us add buy below and sell above to this listing. And Ken, I would be wide open to a suggestion on what do we need to solidify, with this alert concept.
Well, I think we should begin the discussion by indicating that whoever asked the question actually set this alert. This was not something that was set by the database or set automatically. It was set by the person's account, and they actually went into the alerts and set it for a particular numerical value. And now here it is being triggered. So without knowing it, you set an alert for Intel. Now you have to go into the list of the alerts, and you have to either delete that alert if it's not giving you anything useful anymore, or perhaps reset it to a different value if you'd like to see the value higher or lower when it comes to your alert. But again, it's controlled by you. This is not something that's automatically happening to your portfolio.
Absolutely right. In this case, I was asking to be notified if Novo ever got to a par of 12. And that's when it would have triggered for me. Or in this case, I wanted to know if MSC Industrial Direct, I want to be notified if the par sags below 5. So again, these can be maintained, and I think used to much greater benefit as investors. So with that, Ken, I think we can, I'll air out a couple of these with each session until we get to the bottom of the mailbag, if ever. I'll go back to my picture here and wish everybody a great afternoon.
Sounds really good.
All right, I'll be in touch, Ken.
Thank you, Mark. Good night, everybody.
Go Cleveland Indians.
Have a great fall.
Take it easy. See you next week.